in with the poll.
Well, Indian Oil Corporation is expected to report a weak set of numbers in the second quarter of FY23. Now, revenues of the company are expected to be down by around 15%, while the company is also expected to report an EBITDA loss of close to 5,200 crore rupees, while the net loss number is expected to come at close to 5,400 crore rupees, and this will be the biggest loss reported by the company since March 2020. Now, 5 reasons why the company is expected to report a loss. Firstly, there was a refinery shutdown. Then the gross refining margins were on a declining trend. There was inventory losses in the second quarter and forex losses also, while the marketing margins were also on the negative side, and hence because of these 5 reasons the company is expected to report a weak set of numbers. Along with this, the petrochemical segment also continued to remain weak in the second quarter owing to subdued demand and lower product spreads. Now in the second quarter, it was the Paradeep and the Panipat refineries that were partially shut, and because of weaker INR rupees, the company is also expected to report a foreign exchange loss. In the second quarter, if you see the Singapore gross refining margins, they averaged lower at around $7 as against $21 in the first quarter, while the crude also averaged lower by around 12 to 13%, because of which the company is expected to report an inventory loss. Now, in the marketing segment, if you see, though on petrol the losses were lower because the margins that the company earns on selling every liter of petrol was nearly zero, but on diesel the losses continue to remain at around 14.6 rupees on selling every liter of diesel. Now, though sequential basis the losses would be lower, but the company is still expected to report a loss for the marketing segment. Along with this, the key thing to watch out for from Indian Oil Corporation earnings would be management commentary on changes in retail fuel prices. Their outlook on the gross refining margin would also be important to track.
Okay, we